So welcome back once again. Let us take another add-on lesson, and this is about the differences between mutual funds, index mutual funds and the exchange traded funds. Now one of my students, Mr. Ramnath R, he has asked a question and let me read it out. He says your explanation of mutual funds was insightful and your suggestion to consider ETFs for their transparency, real-time trading and low expense ratio is appreciated. He has a few questions. First, he says, since ETFs are traded like stocks, what kind of background knowledge, that means fundamental or technical, is necessary for selecting an ETF? And second, he says, while your course thoroughly covered mutual funds, could you provide similar details for ETFs? For instance, expense ratio, whether, what other factors should be considered for choosing the ETF. And he further says your practical teaching approach is excellent with a focus on relevant and essential details. Would you consider creating a dedicated course on ETFs to share your expertise? First of all, thank you, Mr. Ramnath, for the nice words on my course. Your queries are basically two. One is that you want to know what are the parameters to be considered while selecting an ETF for investment. And secondly, you want me to prepare a separate course on ETFs. Now, you see, I don't think there is a requirement to prepare a separate course on ETFs because whatever we have studied so far under the mutual funds, all those same things are relevant for the ETFs also. So there is no requirement for a separate course. But what I can understand is that there is some confusion in your mind regarding the mutual funds and ETFs. So for the benefit of all students, what I would like to do is I would like to explain to you the key differences between these three things: the mutual funds, the active mutual funds, then the index mutual funds, which are passive, and the exchange traded funds, which are again mostly passive. All right. Once you understand the differences between these three, then you will have a very clear understanding and all your questions will be automatically answered. But before we do that, we actually need to understand the difference between active and passive funds. I really don't remember whether I have explained it earlier during the course, but let me explain it briefly once again, even if I have done it earlier. All right. If you see, if the fund manager and his team, if they apply their mind and their knowledge in deciding where to invest your money, that means if they are doing some work in applying their mind and knowledge, then that fund is called as active fund. But if the fund manager and the team, if they are not required to apply their mind and knowledge in deciding where to invest your money, I'm not saying that they don't apply, but if they are not required to apply their mind and knowledge, then that fund is called as passive fund. All right, appears very simple. Now, why do they have to apply their knowledge or why they are not required to apply their knowledge? All that we will understand as we try to understand the difference between these three things. All right. Let us first take the mutual funds. Now, incidentally, this entire course is about the mutual fund. So we very well know by now what a mutual fund is and how it operates. We know everything about that. But just to recapitulate the key point in context of this lesson, let us say that a mutual fund company issues 1 million mutual fund units, each unit of 10 rupees, or $10 or reals or whatever. Don't worry about the currency. So if 1 million units are issued at the face value of 10, then they would collect, 10 million rupees or dollars, whatever. What they will do with this money? Out of this 10 million, 9.95 million approximately, they will invest in purchasing a basket of stocks, maybe 200, 300 different stocks. And some small amount, let us say 0.05 million, they will keep as cash for any contingencies or redemptions. We have already studied that. And what happens? Each mutual fund unit has now a face value of 10 rupees. Let us say after a year, this basket grows. The value of the stocks in this basket has increased and the asset becomes 12 million from 10 million. So a 20% increase. What will happen to the net asset value of your mutual fund? That will also increase, isn't it? So theoretically that should become 12, 20% increase. But it may not happen like that. It may become only, let us say, 11.75. Why? Because the mutual funds, they are not doing any social work. It is a business, a profession, so they will be taking their expenses and fees. So your value actually becomes 11.75 instead of 12 approximately, let us say. This much we know. Now suppose if more people want to buy mutual funds at the current NAV, what they will do, they will give the money to the mutual fund company. The mutual fund company will give them the units, fresh units. This money will go into their asset under management. They were having 0.05 million cash. That cash will gradually increase. And if the cash increases too much, then they will purchase some more shares and keep the cash to the minimum. So the basket will inflate. Now suppose if the people want their money back, they want to redeem, what they will do? They will give the units back to the AUM or the management company. They will extinguish, tear and throw them away, give the money back at the new rate to the investors. So the AUM will reduce. If too many people come to take their cash back, then probably the company may have to sell some of the stocks and get the money and give them back. The AUM will further reduce. This much we have already studied. All right. So the key point here is that there is no involvement of the stock exchange. Whatever transactions you are doing it directly with the mutual fund company or through your broker, through your financial advisor. And you would observe here that in selecting this basket of stocks, the mutual fund manager and his team, they have to apply their mind, their knowledge, they have to do a lot of hard work. They have to decide when to buy, when to sell, what to buy, what to sell. So this is all done to maximize the returns for the investors. So therefore, they will be charging their management fees, which will be a little high. And therefore, because of the work which they are doing, it is called as active mutual fund. Very clear on that? All right. More about this or more about the index mutual fund and ETF, we shall see in the next part of this lesson. All right.